What happens when the world's largest supplier of a critical industrial metal quietly cuts off exports while everyone else is celebrating New Year's Eve? We're about to find out, because China just executed one of the most consequential resource plays in modern history, and most Americans have no idea it even happened. On January 1st, 2026, 4 days ago, China implemented new export licensing requirements for silver that effectively ring-fenced somewhere between 60 and 70% of the world's refined silver supply for domestic use only. Not gradually, not with warnings. Overnight, the rules changed, and suddenly the global silver market discovered that the metal powering our smartphones, solar panels, and electric vehicles just became drastically harder to access. Here's how they did it. The new regulations require any Chinese exporter to prove they produced at least 80 tons of silver annually and maintained consecutive export records from 2022 through 2024. Sounds reasonable on paper, right? Except this standard effectively blocks about 90% of Chinese silver exporters from participating in international markets. Think about what that means. 9 out of 10 companies that previously supplied silver to Western manufacturers can no longer ship product across Chinese borders. China produces roughly 40% of the world's refined silver. But when you factor in their control over processing facilities, refining capacity, and integrated supply chains across Asia, their actual influence over available global supply reaches closer to 60 or 70%. And now with a single regulatory change implemented while our markets were closed for the holiday, they've essentially nationalized that entire supply stream for their own industrial base. The timing isn't accidental. China is building the world's largest renewable energy infrastructure, manufacturing more electric vehicles than the rest of the world combined, and racing to dominate semiconductor production. Every single one of these technologies requires silver, lots of it. The average solar panel contains about 20 grams of silver. Each electric vehicle uses somewhere between 25 to 50 grams depending on the model. Your smartphone, your laptop, the 5G infrastructure being built across our cities, all of it depends on silver as unique electrical conductivity properties that no other material can fully replace. So while Western governments spent the last several years talking about critical minerals and supply chain security, China actually moved to secure the supply chains. They didn't announce their intentions. They didn't telegraph the policy shift. They simply changed the rules on January 1st and locked down the resource. Now here's where this gets really interesting for us as American investors and citizens. Silver just hit $75.86 per ounce yesterday, January 5th, 2026. That represents a 153% increase from where we were trading just 12 months ago in January 2025. Think about that trajectory for a moment. In 1 year, silver has more than doubled in value, and most mainstream financial media is barely covering the story. But the price movement is only one piece of this puzzle. What should really grab our attention is what's happening to physical inventories in our own backyard at the COMEX exchange in New York, the primary marketplace where silver futures trade and where American institutional investors, manufacturers, and refiners go to access physical metal when they need it. COMEX registered inventories have collapsed by approximately 70% since 2020. We're now sitting at somewhere between 23 and 28 million ounces of registered silver. That's the metal actually available for delivery against futures contracts. To put this in perspective, that's the lowest level we've seen in over 15 years, and it represents roughly 4 to 5 days of global industrial consumption. Just 4 days of supply backing a market where paper contracts trade as if unlimited metal exists. Here's the math that should concern anyone holding silver futures contracts or anyone who manufactures products requiring this metal. The current COMEX open interest, meaning the total number of outstanding futures contracts, represents approximately 1 billion ounces of silver. But remember, the exchange only has 23 to 28 million ounces of registered inventory actually available for delivery. That creates an ownership ratio of roughly 42 paper claims for every single physical ounce sitting in COMEX vaults. Let me put that in terms that hit home. Imagine you bought a concert ticket, showed up at the venue, and discovered that the stadium sold 42 tickets for every actual seat. Then imagine the venue announced that the ticketing company just changed its rules and can no longer provide additional seats from their usual supplier. That's essentially what just happened in the silver market. Except instead of concert tickets, we're talking about a critical industrial commodity that underpins massive sectors of our economy. And it gets worse. Starting January 9th, that's this Thursday, the Bloomberg Commodity Index begins its quarterly rebalancing process. This is a mechanical, automatic event that happens every 3 months where major index funds must adjust their commodity holdings to match prescribed weightings. Silver's recent price surge pushed its weighting in the index too high, meaning these funds are mathematically required to liquidate over $5 billion worth of silver futures between January 9th and January 14th. Think about the convergence here. China just cut off 60 to 70% of global supply on January 1st. COMEX inventories are already depleted to 15-year lows with a 42-to-1 ownership ratio. And now, starting this Thursday, passive index funds must dump over $5 billion of silver futures, representing about 13% of the exchange's total open interest, into this already strained market over the span of just 5 trading days. If you're wondering why silver is up 153% in 12 months, you're starting to see the pressure building in this system. But here's what should really make you pause and pay attention to what's unfolding. Physical silver is currently trading at $130 per ounce in Tokyo and Dubai right now, today, while the paper price on COMEX sits at $75.86. That's an 80% premium for physical metal over paper contracts. In other words, if you actually need silver, if you're a manufacturer who requires the physical metal to build products, you're paying $130 per ounce in Asian markets. But if you're a financial trader buying futures contracts in New York, the screen shows $75.86. This kind of price disconnect between physical and paper markets doesn't happen in normal functioning commodity markets. It happens when the physical metal becomes scarce and industrial users start bypassing the paper exchanges entirely to secure actual supply. China implemented this export licensing change 4 days ago while our markets were closed and Americans were focused on New Year's celebrations. The Bloomberg rebalancing starts in 3 days, forcing $5 billion of selling pressure into a market that's already running on fumes. And the physical premium tells us that industrial buyers worldwide are already scrambling to secure metal at any price because they understand what's coming. The trap is closing. The question isn't whether something breaks in the silver market over the next 2 weeks. The question is what happens to our industrial base, our technology sector, and our investment portfolios when it does. Because once the crowd realizes that China locked the vault and threw away the key while we were watching the rush for whatever physical silver remains accessible to Western markets, is going to make this 80% premium look modest by comparison. And American investors deserve to understand what's happening before that moment arrives. Now, if you're sitting there thinking this sounds too dramatic or too conspiratorial, let me share something that should validate every concern we just discussed. Because the smart money already moved, they already repositioned. And they did it using the exact same playbook Michael Burry used before the 2008 financial crisis, betting against the system while everyone else remained blind to what was coming. J.P. Morgan Chase, one of the largest financial institutions in America, and historically one of the most significant players in precious metals markets, executed what might be the single largest position reversal in commodity trading history. And most Americans have no idea it even happened because it unfolded quietly over several years, while mainstream financial media focused elsewhere. Here's the story, and I want you to pay close attention to the mathematics here because the numbers tell you everything you need to know about what the largest banks in the world believe is coming for silver markets. For years, JP Morgan held a massive short position in silver. A short position means they were essentially betting that silver prices would fall. They sold silver they didn't actually own, planning to buy it back later at lower prices and pocket the difference. According to data from the Commodity Futures Trading Commission and analysis from precious metals researchers, JP Morgan's short position at its peak represented approximately 200 million ounces of silver. That's not a typo. 200 million ounces they had sold but didn't own, betting that prices would decline. This kind of position gives an institution tremendous influence over market prices. When you're short 200 million ounces in a market where total annual mine production runs around 850 to 900 million ounces globally, you're a major force in price discovery. Your trading activity, your ability to supply paper contracts, your willingness to defend certain price levels, all of this shapes where silver trades day to day. But then something changed. Starting around 2011 and accelerating dramatically after 2016, JP Morgan began systematically reversing this position. They started covering their shorts, buying back those 200 million ounces they had sold, and then they kept buying and buying and buying. Physical silver, stored in their own vaults, accumulated month after month, quarter after quarter, year after year. The best available analysis suggests JP Morgan has now accumulated approximately 750 million ounces of physical silver. Let me say that again because the scale is difficult to comprehend. 750 million ounces. That represents roughly 75% of total annual global mine production. It's the largest private silver stockpile in recorded history, and it belongs to a single American financial institution that spent years betting against silver before completely reversing course. Do the math on what this means. JP Morgan went from being short 200 million ounces to being long 750 million ounces. That is a net position change of 950 million ounces, more than an entire year of global silver production. You don't make a nearly 1 billion ounce position flip in a commodity market unless you have extraordinary conviction about where prices are headed, an extraordinary understanding of the supply-demand fundamentals that everyone else is missing. Now here's where this gets interesting for those of us who remember the 2008 financial crisis. Michael Burry, the investor whose story was told in the book and movie The Big Short, made his fortune by identifying a systemic problem in financial markets that everyone else denied or ignored. He saw that mortgage-backed securities were fundamentally mispriced relative to the actual risk in the underlying loans. So he bought credit default swaps, essentially insurance contracts, betting that these securities would collapse, while everyone from major banks to rating agencies to government regulators insisted everything was fine. Burry looked crazy for years. He faced redemptions from his own investors who thought he had lost his mind. The trade moved against him as housing prices kept rising and the party kept going. But he understood the mathematics. He understood that when you have a structural imbalance between what the market believes exists and what actually exists, eventually reality catches up to perception. And when it does, the snapback is violent and devastating for anyone caught on the wrong side. JP Morgan's position flip in silver is following the exact same pattern. For years, the bank participated in and arguably helped facilitate a paper silver market where contracts traded as if unlimited physical metal existed. They were short, meaning they profited from keeping prices suppressed and maintaining the illusion that silver was abundant. But at some point, likely as they analyzed industrial demand trends, Chinese production and consumption patterns, and the mathematics of declining COMEX inventories, they realized the paper market was fundamentally divorced from physical reality. So they did what Burry did. They positioned themselves to profit from the inevitable reconciliation between paper prices and physical scarcity. They covered their shorts, accumulated the largest physical position in history, and now they're waiting for the market to discover what they already know. There is not enough silver to meet both industrial demand and the obligations represented by paper contracts trading on exchanges. The evidence for this structural supply deficit isn't speculative or theoretical. According to the Silver Institute, the industry's primary research organization, global silver markets have operated in deficit for 5 consecutive years, from 2021 through 2025. A deficit means that total demand exceeded total supply from mine production and recycling. The market consumed more silver than was produced, and the gap was filled by drawing down existing inventories. The 2025 numbers paint a particularly stark picture. Total demand reached approximately 1.24 billion ounces. Total supply from all sources, mining, recycling, government sales, came in at about 1.01 billion ounces. That's a deficit of 230 million ounces in a single year. Where did that 230 million ounces come from? It came from inventories, from stockpiles, from registered and eligible silver sitting in exchange vaults and commercial storage facilities around the world. This is why COMEX inventories collapsed 70% since 2020. This is why registered silver available for delivery dropped to 15-year lows. The market has been consuming stockpiled metal for 5 straight years to bridge the gap between what mines produce and what industries require. And JP Morgan understood this trend years before it became obvious to the broader market. Industrial demand now accounts for roughly 60% of total silver consumption. We're not talking about jewelry or investment coins here, although those sectors matter too. We're talking about solar panels, electric vehicles, 5G infrastructure, semiconductors, medical devices, water purification systems, and dozens of other applications where silver's unique properties make it essentially irreplaceable at current technology levels. The solar industry alone consumed approximately 161 million ounces of silver in 2024, and that number is projected to grow as renewable energy deployment accelerates globally. Each electric vehicle contains 25 to 50 grams of silver in its electrical systems. The transition to EVs that every major automaker is pursuing means silver consumption from this sector will only increase over the next decade. 5G build-out requires significantly more silver per unit of infrastructure than previous generations of wireless technology. And here's the critical point that JP Morgan obviously understood when they started accumulating their position. There are no new primary silver mines coming online. Primary silver mines, meaning mines where silver is the main product rather than a byproduct of copper, lead, or zinc mining, require years of development, billions in capital investment, and silver prices sustained well above current levels to justify that investment. Most silver production comes as a byproduct of other metal mining operations. This means silver supply is relatively inelastic. Even if silver prices double or triple, you won't see a massive surge in new supply hitting the market quickly because the supply is tied to the economics of producing other metals. Copper mines produce silver as a byproduct. Lead and zinc operations produce silver. But these mines don't ramp up production just because silver prices rise. They respond to copper, lead, and zinc economics. So when demand is growing by double-digit percentages annually in key industrial sectors, and supply is effectively capped by the production economics of other metals, and inventories have been drawn down for 5 consecutive years to fill the gap. Eventually, you hit a mathematical wall. You reach a point where there simply isn't enough silver in accessible inventories to bridge the deficit anymore. JP Morgan saw this coming. They positioned for it, and they did so by accumulating the largest physical stockpile in history. Metal that can't be created out of thin air through derivatives or paper contracts. Metal that exists in their vaults and can be delivered or held as long as they choose. The bank's positioning got even more aggressive in late 2025 as the pressure on COMEX intensified. In December, the exchange faced delivery demand for approximately 65 million ounces. Think about what that means against a registered inventory base of only 23 to 28 million ounces. Traders and industrial users were demanding more than double the amount of silver that the exchange actually had available for immediate delivery. Rumors began circulating that COMEX was pushing cash settlement, essentially telling contract holders, "We can't deliver the silver you're contractually entitled to, so we'll pay you the cash equivalent instead." Whether those rumors were accurate or not, the Chicago Mercantile Exchange, which operates COMEX, issued Advisory Notice 25-393 raising margin requirements to $25,000 per contract. This move was designed to prevent what they feared was coming, a delivery squeeze that could collapse the entire paper silver market. When an exchange raises margin requirements dramatically, they're saying, we need to reduce the number of people who can afford to hold contracts and potentially stand for delivery, because we don't have enough physical metal to fulfill our obligations if too many people ask for actual silver instead of just trading paper claims. This is the scenario Burry understood in housing markets, when the paper claims exceed the underlying asset, and when the fundamental mismatch becomes severe enough that the system has to change its rules to prevent collapse, you're in the late stages of a structural crisis. The reconciliation between paper and physical is coming. It's just a question of what triggers it and when. JP Morgan is positioned on the right side of this trade. They're long 750 million ounces of physical metal. They're not exposed to paper contract risk. They're not vulnerable to COMEX running out of inventory or changing settlement rules. They own the actual metal, stored in their own vaults, and they can simply wait for prices to reflect the reality of industrial demand outstripping available supply. The bank that was once short 200 million ounces, betting against silver, profiting from its stagnation, is now sitting on the largest long position in history. That's not speculation or conspiracy theory. That's mathematical fact based on publicly available data about their silver holdings. When the largest financial institutions reverse course this dramatically, when they flip from maximum short to maximum long, when they accumulate more physical metal than entire countries possess, you need to pay attention. Because they're not making a bet. They're positioning for mathematical inevitability. They're preparing for the moment when the rest of the market discovers what they already know. And with China's export lockdown now in effect, with COMEX inventories at 15-year lows, with the Bloomberg rebalancing forcing $5 billion in liquidations, starting Thursday, with physical premiums already at 80% over paper prices. That moment is getting very, very close. So let's talk about what happens over the next 9 days. Not speculation, not theory, mathematical inevitability based on the mechanics of how commodity markets function when multiple crisis points converge simultaneously. We've established that China cut off 60 to 70% of global refined silver supply on January 1st. We've established that JP Morgan positioned itself on the long side with 750 million ounces, while COMEX inventories collapsed to 23 to 28 million ounces. Now we need to understand what occurs when $5 billion in forced institutional selling hits this already fractured market between January 9th and January 14th. The Bloomberg Commodity Index rebalances quarterly. This is not a discretionary decision by some portfolio manager who can delay or adjust based on market conditions. This is a mechanical process governed by index methodology rules that must be executed regardless of what's happening in underlying markets. Think of it like a computer program running on autopilot. It doesn't care about inventory levels, Chinese export restrictions, or physical premiums. It simply executes the prescribed rebalancing according to its mathematical formula. Silver's weight in the Bloomberg Commodity Index must be reduced from approximately 9% down to under 4% during this rebalancing window. The reason is straightforward. Silver's price surge over the past year pushed its market capitalization too high relative to other commodities in the index. To maintain the index's prescribed weightings across its basket of commodities, The passive funds that track this index, most of the time when people think about the origins of economic thought, they jump straight to Adam Smith, Karl Marx, or maybe Aristotle, if they paid attention in school. But there's a quieter truth hiding in the medieval world, a truth Western history rarely teaches. Nearly 1,000 years ago, long before capitalism or central banks existed, a Muslim scholar issued a warning that still echoes across every financial crisis today. He said that when money loses its moral compass, societies rot from the inside out. And judging by the world we live in, he might have understood us a lot better than we think. Welcome to the Financial Historian, where money, power, and history collide, and nothing is ever as simple as it looks. To understand Al-Ghazali, one of the most influential thinkers of the Islamic Golden Age, you have to imagine a world that looked both familiar and foreign. The years around 1100 CE, Europe is fragmented and poor, still crawling out of the wreckage of the early Middle Ages. Meanwhile, the Islamic world stretches from Al-Andalus in Spain to Persia and beyond. Its cities are wealthy, crowded, sophisticated. Baghdad, Damascus, Cairo. These are financial and intellectual powerhouses. Trade routes pulse with caravans carrying silk, spices, textiles, and silver. Scholars debate philosophy, law, astronomy, medicine. The markets are busy, the empire is rich, and wealth is transforming society faster than anyone can fully understand. In this world of booming commerce and rising inequality, a scholar named Abu Hamid al-Ghazali emerges, part philosopher, part jurist, part theologian, part critic. Think of him as the kind of thinker who could explain both the purpose of the soul and the purpose of a currency system without blinking. Born in 1058 in Persia, al-Ghazali rose quickly through the intellectual ranks. By his mid-30s, he held one of the most prestigious teaching positions in the Islamic world. But what made him unique wasn't his prestige, it was his unwillingness to accept the status quo. He saw a world where wealth was growing, markets were expanding, and yet something felt off. A society obsessed with money but drifting away from meaning. An economy thriving outwardly but decaying inwardly. You don't have to try hard to see the modern parallel. Al-Ghazali began asking a question few had dared to ask. What happens when a civilization gets rich faster than it gets wise? And to answer it, he turned his focus to the concept of money itself. This is the part that surprises most Western viewers. Al-Ghazali wasn't just a religious thinker, he was one of the earliest philosophers to analyze money in moral and systemic terms. Where Aristotle saw money as a practical invention, and later economists analyzed it mathematically, Al-Ghazali examined its psychological and spiritual impact on a society. He looked at how money shapes behavior, incentives, trust, and ultimately the fate of nations. To understand his economic ideas, you first need to understand how he saw money at its core. For Al-Ghazali, money was not meant to be worshipped, hoarded, or used as a status symbol. It was a tool, nothing more, a facilitator of exchange. He compared money to a mirror. A mirror has no value on its own. Its worth comes from what it reflects. Money is the same. Its power lies not in the gold or silver itself, but in what it allows people to trade, build, and cooperate. It's an idea modern economists like to claim as their own, but Al-Ghazali was writing it in the 11th century, when many Europeans still understood wealth mainly as land or loot. And from this foundation emerged one of his most important insights. Hoarded money is dead money. To him, wealth locked away in chests, hidden in rooms, or buried in courtyards wasn't just useless, it was socially destructive. Idle wealth doesn't circulate. It doesn't feed workers, fund trade, or support families. It strangles economic life. He described it as freezing the bloodstream of society, a line that could easily appear in any modern critique of inequality. But Al-Ghazali wasn't simply complaining about greed. His argument was systemic. When the wealthy hoard money, they create scarcity, not because resources are lacking, but because circulation is blocked. Prices distort, markets break down, people suffer. This critique leads to his next major idea. Speculation destroys trust. Al-Ghazali had no patience for merchants who manipulated prices, created artificial shortages, or exploited crises for profit. He saw speculative behavior not as clever strategy, but as moral corruption. Profit without contribution. Whoever profits from the suffering of others, he wrote, profits from corruption. And corruption, in his view, was a contagion. Once it takes hold, it spreads through markets, institutions, and eventually the entire society. If this sounds like a commentary on modern financial bubbles, predatory lending, or crisis profiteering, well, it is, just written 900 years earlier. But Al-Ghazali wasn't anti-profit. He wasn't anti-business. He wasn't calling for monasteries or poverty vows. He believed in trade strongly. He believed markets were natural and necessary. He believed wealth could be meaningful and even noble. His real target was dishonest trade, cheating, lying, using false weights, concealing defects in products, or manipulating information. He believed that markets function only when the participants trust one another. And once trust collapses, the economy collapses right behind it. In that sense, he was one of the earliest thinkers to describe what modern economists now call transaction costs, information asymmetry, and moral hazard, just without the jargon. Another of his key insights was the value of labor. He argued that work was inherently dignified, while unearned wealth was spiritually dangerous. To him, money earned through effort built character, while money accumulated through manipulation rotted it. That might sound moralizing, but the logic was practical. Societies grow strong when people contribute. They grow weak when people exploit. But Al-Ghazali didn't stop with individuals. He also delivered one of the earliest critiques of state intervention in currency. Medieval rulers, like many modern ones, often diluted gold or silver coins to stretch their budgets, effectively taxing people through stealth inflation. Al-Ghazali condemned this practice outright. To him, debasing currency was theft. It eroded trust in the market. It punished the poor who received weaker coins. It destabilized the financial system from the top down. He believed the state had a role in maintaining fair markets, but that role was limited. Leaders should protect the economy, not manipulate it for short-term gain. He warned that unjust rulers destroy prosperity faster than any outside enemy. And once again, the modern parallel doesn't require explanation. Al-Ghazali's warnings about rulers did not emerge from abstract theory, but from watching the real behavior of real states. In his lifetime, political fragmentation was increasing, dynasties fought for legitimacy, local governors pushed for more revenue, and as always, when rulers felt their grip on society slipping, the very first place they tightened their hands was the economy. Some raised taxes to painful levels. Others manipulated coinage to stretch their budgets. Some seized merchant assets, while others borrowed recklessly and left future generations to deal with the consequences. None of these tactics were new, and none of them, in Al-Ghazali's eyes, solved the underlying problem. He believed corruption at the top radiated downward like a poison. When a ruler cheated his people, the merchants felt justified in cheating their customers. When institutions failed to act with integrity, individuals no longer saw any reason to act with responsibility. The entire economic order, from the palace treasury to the neighborhood market, became a chain reaction of distrust. His conclusion was stark, but simple. A society can survive poverty, but it cannot survive corruption. Economic collapse is rarely about running out of money or resources. It is about the breakdown of trust, the invisible glue that holds every transaction, every contract, every currency, and every institution together. When that trust erodes, even the wealthiest nation becomes fragile. From this perspective, his ideas about currency make sense. To Al-Ghazali, currency stability depended entirely on honesty. Debasement of coinage, diluting gold or silver content, wasn't just poor policy, it was deception, it was betrayal. A ruler who tampered with currency was not being clever, he was stealing from his own people in slow motion. What looked like a minor alteration to a coin's purity was, to Al-Ghazali, the beginning of financial rot. He predicted that if states manipulated currency too often, the population would eventually lose trust, abandon the local coin, and start using stronger foreign currencies instead. 1,000 years later, these dynamics played out in Weimar Germany, Zimbabwe, Venezuela, Argentina, and every modern case where people flee their own money because they no longer trust the promises behind it. Meanwhile, inflation debates and anxieties in the 21st century reflect exactly what this medieval scholar understood, that money is ultimately a belief system, and once people stop believing, the system stops functioning. But Al-Ghazali's view of finance went beyond currency and taxation. He understood something deeper about human nature. People hoard out of fear. They speculate out of greed. They cheat when they think they can get away with it. They manipulate money because money is easy to manipulate. They rationalize unethical profits because everyone else is doing the same. And when a society reaches the point where exploitation becomes normal, collapse is already underway. This belief guided one of his most powerful insights. You cannot fix an economy without fixing the incentives that shape human behavior. Laws matter and markets matter, but behind them all are people making choices driven by emotion, ambition, fear, and desire. Unless a society's systems align those incentives toward productive, honest behavior, the economy will drift toward corruption, instability, and self-destruction. This is why Al-Ghazali placed so much emphasis on the moral dimension of wealth. To him, wealth without responsibility was not just spiritually dangerous, it was a threat to the common good. He believed wealth was not inherently bad, it was simply incomplete without purpose. A society grows strong when individuals contribute more than they extract, when the drive to accumulate is balanced by the duty to uplift. But when wealth becomes detached from social responsibility, when the pursuit of profit ignores the welfare of the community, the system becomes brittle. brittle.
paper fiction.
The selfish
Waiting for
society
physical
eventually
reality to
collapses under its
reassert
own weight. And once it
trap's closing.
collapses,
The collision
everyone
is coming.
pays, including the wealthy who thought they were immune.
The smart
Civilizations rise when people understand balance. They fall when that
The
balance
rest of
snaps.
us are about to
And that
find
brings
out
us
what
directly
happens
into the
when
modern
everyone
world.
else finally
A world where
sees
Al
what's hiding
Ghazali's
in plain
insights
sight
feel
the
less
entire
like
time.
medieval